If you're wondering whether life insurance is a good investment or not, the quick answer is no, because life insurance is not an investment. It is insurance. The number one reason you buy life insurance is if you actually need the life insurance part of it. If your death will cause a loss of income that hurts someone you care about, then you should consider life insurance to come in with an amount of money to help them out. That said, life insurance does often have some savings or investment parts to it. So let's take a look to see how you can use the investment parts of life insurance as an additional part of the life insurance for your retirement planning. Now, one thing to keep in mind with the life insurance is that it is tax advantaged. When you put money into life insurance and it's earning some sort of cash value, some sort of way, there's interest, dividends, credits, whatever you want to call it, that are inside of that life insurance. You might have earned a bit of interest, you might have earned a dividend, but as long as it's inside the life insurance, you're not paying the taxes yet. That is a tax advantage. As the money stays in the policy, perhaps it keeps on growing so that you have more and more money later on that you have yet to pay taxes on. And when you take money out of life insurance, the amount you put in is called the cost basis. The premiums you put in, you've already paid taxes on. So as you take out that money you've put in, as you take out that amount can come out tax-free. Now, do keep in mind, there is a way that you could put money into life insurance where it's almost like you put too much money into life insurance, where the government says you've put in so much money, it's starting to act more like an investment or savings type account. And they'll call that a modified endowment contract, where they switch how the taxes show up on life insurance. If it is not a modified endowment, if it is regular type of insurance, when you call up your insurance company and take money out, that principal comes out first. That cost basis comes out first. That is a tax-free return of your principal. But if you've put in so much money that it has gone above into the modified endowment contract area, and you call up your insurance company and say, I want the money out or some money out, it will be your interest that comes out first. It's kind of like how an annuity works, where it's your interest, your taxable amount that comes out first. So keep in mind, as you're adding money to insurance, if you want to add extra money in so that you can grow it however it grows, then is it going to be a modified endowment or not? If you want to preserve the best part of the tax advantages, you would want to make sure it's not a modified endowment contract. You might want a modified endowment for different reasons, but keep in mind how that tax advantages work. Another key part of perhaps investing extra money into your life insurance is that it's most likely going to be something called whole life, universal, maybe even indexed universal life, which is backed by the insurance company that issued that insurance account. It's not like a mutual fund that goes up and down in the market if it's that type of insurance, that whole life, universal, index universal. And the insurance company then takes your money that's with them and they invest it into most likely bonds or things that are like bonds. So if you're looking at your insurance account and wondering what you'll get for interest, you are most likely to match the returns of the bond market because that's the underlying investments the insurance company is mainly using. So when you see an advisor that suggests that your life insurance cash value is going to replace your stocks, keep in mind that's probably not the case. If you're investing in whole life, universal, index universal life insurance, that is not invested to the stock market. That is with the insurance company. It's in their general account, it's called, and they are most likely, most of the time, using bonds, and the bond-like returns are something you should expect as opposed to stock-like returns. Here's a couple of risks when you're using life insurance as an investment. One big thing just to keep in mind is when the insurance salesperson tells you that you can get investment parts of your insurance, they will be getting commissions from you putting money into the insurance. They might not be getting commissions from your 401k. They might not be getting commissions from your Roth IRA, but they will be getting commissions then when you add money into the insurance. And with that, the insurance company, because they paid out that commission to the salesperson, they want to recoup the cost of paying out that large commission. That's why you often see a penalty called surrender charges that might last for 10 years or more. What they're doing is saying they paid out a commission up front, and they want you to keep that money for 10 years or more in the insurance policy. And if you take it out earlier, you'll end up paying a surrender charge. So check into the surrender charges, check into the surrender period, and realize that life insurance is a long-term commitment. Make sure you have the funds to project out that premium for at least 10 years fully, or however long that surrender charge is going to be. And think of other places you might invest money. The Roth IRA, health savings account, Roth or traditional 401ks, your savings account. They often don't have a 10-year period where there's a penalty for taking it out early. So keep in mind that life insurance is a long-term type of commitment. If you're buying life insurance to meet that primary purpose of paying the large death benefit, and you want to perhaps add more money into it, take a look at how you could use life insurance for investments, but compare it to your other alternatives, your Roth IRAs, your HSAs, your 401ks, your savings accounts. Those quite don't often have the long-term commitment that life insurance does, but they do have maximums, which is why you may be considering looking at life insurance as a way to put additional money in towards your future savings. Hi, I'm Jeremy Keil, owner of Keil Financial Partners. And if you're interested in seeing how we help our clients get more income, pay less in taxes, and avoid big retirement mistakes, make sure to go to keilfp.com. That's KEILFP.com.